What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. I am back with another edition of the Macro Insights podcast. And I'd like to thank everybody streaming sats. And I hope everybody had a great Thanksgiving holiday for all the American listeners out there. And I've got a very, very special guest coming off this holiday break. I got SB from the Woke Antidote. And if you've heard on the spaces and other places, you know that he's got a great mind when it comes to all this macro stuff. So I brought him on to kind of come and make sense of what's all going on. So SB, welcome to the show. And yeah, welcome back, man. How was your Thanksgiving?
You know what is going on, man? Great to be back. Loved the times I've been on. Loved the time you were on our show. And yeah, Thanksgiving was great. Always good to see the fam. Always good to have some excellent food. And then, hey, as Thanksgiving turns, immediately it's Christmas season. So I'll be putting my NSYNC Christmas album on. Already played a few songs already, and that'll be that for the month of December.
Yeah, there we go. The NSYNC Christmas album. That's awesome. I mean, I feel like Mariah Carey makes like her entire net worth from like as soon as the clock strikes November 1st on. For that All I Want Is Christmas Is You, all that streaming play. She must make a shit ton of money just these last 2 months of the year.
She has to, but yeah, for any listeners out there, if you are not familiar with the Instant Christmas album, that's a must. After the show ends, get to it ASAP because that just has some absolute Christmas bangers.
Bangers for days. There we go. Didn't think you were gonna get bangers for days when you came on listening to the Macro Insights pod, but you get a little bit of everything. But let's get down to brass tacks. So we got a crazy kind of macro environment going on right now. So I'm gonna leave the floor open to you. Is there anything that's kind of like striking your catching your eye these days that it's pretty alarming? I mean, obviously there's a lot of different numbers that are coming out. We got inflation still, in the sevens, according to that CPI print. We got unemployment rising. We're seeing a lot of these growth companies kind of take a turn for the worse. So I'll leave it open for you. If you've got anything initially that you want to kind of get into, go for it.
Yeah, so I was intrigued. We were talking briefly before the show, and I was intrigued by the point of the growth companies because, I look at these charts as you do, and as your audience does, and you see crazy stuff like Carvana, goes from 300 to $7. They might be bankrupt soon. Upstart, I think that was the famous one. The guy goes on CNBC, doesn't even know what they do. Companies even like a Coinbase goes from 350 or 400 to $50. Netflix 700 to 200 at the worst. So there's all of and that was supposed to be an established company. So there's all these crazy growth moves, and I kind of wanted to give my theory on why I think it was sort of a perfect cocktail for what happened to growth companies to get us to those heights and then to the lows. Because I think what we need to observe right now is, at least for the moment, we've left ZERP. We've left zero interest rate policy. We've left QE, quantitative easing. We might get back to it, but for the current environment, that's just a massive step up change from where we were at from the 2010 through 2020, when interest rates were kept pretty much at zero. I think in late 2018, we attempted to raise a little bit, and then we brought it right back down. So these companies that were created in the 2010s, they were being judged on what does that business look like 10, 15 years from now. And if I can see what a potential cash flow might be, maybe the total addressable market analysis, I don't have to discount that much because the interest rates are so low. So simplistically, if in 2017 or 2018, Netflix is burning $3 billion of cash. Well, if that's enabling them to get massive scale and they can get $20 billion of free cash flow in 2030, that's almost as valuable to me as $20 billion of free cash flow today because interest rates are zero. So what happened is you had all of these companies responding to the market, to be fair to the companies, chasing these crazy growth metrics. So earnings didn't matter. It was all about how fast can you grow revenue, how fast can you grow subscribers, how fast are you growing into your total addressable market. So we had that environment going on. Pandemic hits, then these businesses that relied on these growth metrics, their growth metrics got supercharged during the pandemic because we were all at home and we were online. And then we put interest rates back to zero, and the expectation was we were going to be at zero for years. I mean, if you go back to the Fed quotes from the mid 2020, they were talking about not raising rates for a long time. So you had those two changes as well. So that's when you had these sky high valuations because you looked at these companies and take Carvana for example. They were burning, I think, over multiple billions of dollars a year. But the market was assessing if Carvana can truly become this global scaled player, they're going to make they have the potential to make so much money in the long run that we're going to bid them up. They're the ultimate like longer duration asset. We're going to bid them up like crazy. And so then in late 21 and 2022, when they started raising rates, first of all, a 75 basis point rate is insane. That usually does not happen. So the fact that we're getting them back to back to back, that's just a totally different environment that no one's really seen. So these companies now they're higher rates. You have to discount their future earnings by 4% or 5% a year, and not the zero that was ZERP. The pandemic came and went, and now the benefit they got from everyone being online is now a decelerant. And then third, you have the economy slowing. So you put that cocktail together, and then you can kind of see, all right, that's what happened. Where I don't think it should have happened. I don't think the market should be changing this much. If we'll talk about Saylor and MicroStrategy, I think one of the great points Saylor has made recently is you have $400 trillion of assets that were using a risk-free rate that just recently changed 300 basis points in 6 months. That's going to be a shock to the system. And we already saw the shock in terms of the some pensions in the UK and whatnot, and we'll probably see more. But I just think I wanted to touch on that of how this actually happened because I think it's totally fair to look back and say, like even Netflix, an established company, why did their stock go from 700 to 200 when yeah they missed their subscribers by a little bit, but it wasn't that crazy. Well, what happened was in 2019, Netflix and the Carvanas of the world, they responded to, oh, the equity market's giving us credit for investing like crazy and burning all this cash. So all these companies did that. And what you do when you respond to the market is, yes, you ultimately want a higher stock price, but if the stock market's favoring your metrics and your growth metrics and they're giving you a high valuation, that allows you to do other things too. So, for example, Carvana, they issued bonds at less than 5% interest rates, and where are those bonds trading now at in 30 cents, 40 cents in the dollar? But part of the reason they were able to do that is because the bond market looked at Carvana having this massive market cap and said, "Oh, I'm protected. The market values this company at 100, 200 billion, whatever it was. They raised a billion or 2 billion of bonds. Easy. That's fine for me. I'm going to be paid off." And then it turns out it was so volatile it doesn't. So I guess I'll end it there by saying that volatility is crazy, but we have seen that, I think, in the equity market before. The big thing that I hear today is that from people that have been in this business for decades, they're saying the treasury market volatility is the worst they've ever seen. And so that obviously impacts, all different asset classes, but just kind of going back to the Sailor point, why is this risk-free rate changing so much? Like did the world change that much where it should be that different? And I would say no. And then it would go back to, and you talk about this a lot in the show, maybe there's an alternative to people at the Federal Reserve controlling interest rates like this, and maybe there's something else that we can do besides kind of using human error for this. But Yeah, I figured I'd start there because you piqued my interest in why all these growth companies are seeing just horrible performances lately in the stock market.
Yeah, and I think, going back to some of our older conversations too, I've listened back to a little bit too, and I think like we've kind of talked about this before like I guess the volatility and the massive crashes to a lot of these stock prices, just talking about the crazy evaluations of a lot of these companies. Their PE ratios didn't even matter, number or stocks always go up kind of environment in COVID and all that liquidity and everything like that, just so much access to capital just allowed these stocks to soar and just keep kind of continuing up. And now, like, I kind of agree with you. I think it's almost overcorrected in a sense where it's come crashing down. And, that's kind of where we're at. But I'm interested kind of to where you see, I guess, the valuations to going from here. Do you think, kind of the value investing principles are going to kind of come back to some of these? And yeah, what do you and then yeah, then I want to get into, I guess, more of the job market and some of these growth companies, because I think that has also been, a big issue where we've seen these tech companies, people jump from job to job getting, 15% raises just to move, like a lateral move, if they go from one tech company to the next. So yeah, I'll leave it there. Do you think, one, the valuations are going to kind of get, I guess, more in kind of the value sense? And two, what do you think of the overall job market in a lot of these and like tech companies where you've seen, people just getting paid a lot more than actual work than they're doing?
Yeah, so first I would say I don't really blame these companies. Yeah, there's some strategic errors here and there, but for the most part, the companies were simply responding to what the market demanded. And even I'll leave aside growth companies for a second and look at media companies beyond Netflix, Paramount, Disney, even Comcast with Peacock. Peacock, they're spending $2.5 billion on, or they're losing $2.5 billion in 2022. All of these quote unquote legacy media companies, they responded to in 2019 the market valuing Netflix like they did. A lot of companies have done that. And the access to capital is such a huge benefit to these companies because ultimately at the end of the day, you want to make sure that you have access to capital at all times. So I think if there's one thing I can disagree with some of these companies on, it's being too short term focused on what the market wants, and then also not raising equity at the top. So if you're some of these companies, I mean Carvana, there's rumors that, or not I guess rumors, but people are looking at their financial statements and saying they might go bankrupt soon. Why didn't you raise a decent amount of cash at the top using equity issuance that could have done that? So that's what I would start with, which is, maybe that's the one thing I disagree with a lot of these companies. But what I think is happening now is it's up to the investor to decide, is the cash burn actually investments or just an unprofitable business? Because I think if you zoom back a couple years, the cash burn was rewarded. And there's a famous quote from Reed Hastings, the CEO of Netflix, where he says, higher cash burn is an indicator of enormous success, which is just unbelievable that was said, but that was viewed positively at the time. And the reason for it was because he was viewing it and the investors were viewing it in that if you burn more today, you're going to have more scale and more pricing power tomorrow. So in the QE era, the ZERP era of the 2010s, it was almost as if like the more cash burn you could get away with, the more the market was valuing your company, and it almost didn't really even matter what was going to happen in 5 or 10 years. It was just what was happening today. I
Well,
think now
let
you're going to see
interject.
companies.
Let me interject with you right here because I have a question to see if it even is, because you said it's from the 2010 to the 2020 kind of era, and I kind of think it might be even earlier than that. I think a lot of companies saw the model that Amazon had, which essentially is the cash burn and then obviously expand the business later and then figure out how to make money later, and that's kind of how they went through it. And yeah, the easy access to capital and all that obviously helped Amazon kind of grow. But obviously, not every company is Amazon. So I feel like every CEO and founder kind of had that in their little back pocket to kind of pull. And do you think that that was maybe a reason as well?
I think that's totally part of it because the the classic, if you're a growth investor, when someone says, "Hey, you're burning all this cash and you have all this scale, but what? How are you actually going to make money?" Then they go, "Oh, like we'll find an AWS." And the problem with that, finding an Amazon Web Services, is that's an incredible business. At least it is right now. So it's anyone can burn the cash like Amazon did, but are you able to find an AWS? That's pretty rare. So, so going back to what I was saying, which fits in exactly with what you're saying, investors now have to assess, oh, can a company find an AWS with all they're doing? Now, they're not going to find exactly that, but for example, if you're looking at a DoorDash, okay, so DoorDash ultimately the margins on food delivery probably won't be that high, right? So, then there's the question of, okay, can they do advertising? And if so, can they make money on that? Amazon makes a lot of money on advertising for buying their products. Can DoorDash do dark stores where essentially they have so much information on the demand of what consumers want, they can get into selling the actual products and having the actual stores rather than outsourcing that and using, a CVS, for example, for a convenience. So that's kind of one area. I think another stock I would think about is Spotify, where Spotify, they've had, I mean, so much scale for years now, and they've gone into the podcast business. And when they did these deals with Joe Rogan and Bill Simmons and all these big popular names, their stock ripped. I mean, I think the Joe Rogan deal, the stock was up 10% that day. Well, they're actually not even making money, and they're increasingly losing money on the podcasting business, and their existing music business is not making much money. So if you talk to Spotify bulls, what they might say is, "Hey, Spotify has this incredible scale. They're bound to find something." So yes, that can be a bull case, but you need to have a pretty good idea of what they might be able to find, or have some various theories there. When you talk to a company, or when you talk to bulls of a company, and they don't, and they just say, "Oh, they're going to find something," that's when it might be off, because ultimately, you don't have to sit here in 2022 and say Spotify is going to have X amount of profits in live events or ticketing by 2027, but you at least want to see a little bit of progress. So I think that's kind of where I would be looking is there, maybe it's low, maybe it's small, is there some progress in terms of getting to more profitable growth? And I would use Meta as an example. I know you've talked about that on the show a lot. I think they have this very small segment of monetizing WhatsApp, I believe. I don't know exactly what it is, but like that segment grew 70% revenue or something. So like that's the kind of thing I would be thinking about is, okay, if you're very familiar with the core business and what it does, what are the offshoots? Are they giving you data enough to assess it? And then, combine that with your qualitative understanding of the market. Okay, yeah, I can be comfortable with a little bit of a lower valuation on these companies now that the market's taken them down, and I'm interested in growth segment A, B, and C, and I think they've each got a pretty high shot of working out. So that's kind of where I would be looking at it, as opposed to I really don't think a lot of that analysis was being done in the 2010s, simply because it didn't really need to be done.
Yeah, I agree with you. Like you said, it wasn't needed to be done, but I think we're at the point now too where now this is a lot of pressure on the founders or the leadership of the companies, right? Because you need a Jeff Bezos to find an AWS, you need somebody else like, all right, a Mark Zuckerberg to find a metaverse or whatever. Obviously, you and I have talked at lengths of our opinions on how we don't think that the metaverse is going to work or anything like that, but you have to see a founder kind of take these risks in order to, see that exponential growth. So, I kind of see a lot of these companies, going to be swinging for the fences, and we might see some of the big boys kind of die. And we're seeing a lot of the layoffs kind of coming now soon, as well. and some of the, obviously this dilapidated stock prices of a lot of these. So, do you, what's your overall outlook? Do you think, a lot of these companies are going to kind of do something like a metaverse or a meta, where they invest a shit ton of money into something that's, maybe not going to work out like the metaverse? Or do you think like, the ones that make it are going to be the ones that kind of like hit these singles and doubles kind of thing? And like, although their stock prices are, down, they're not really taking these huge swings and potentially missing.
Yeah, I think metaverse is that's an isolated incident where you've got this guy who has total control over the company, won't ever give it up. The ability for him to be burning that much money on a project with incredibly uncertain future cash flows, that's just rare. And I think even like going back to the AWS example, Amazon was doing that internally first and then brought it to the rest of the market. So at least there was a product fit because they themselves knew they needed it. With this, there is no guarantee of a product market fit. And one of my thoughts is I look at a company like Apple, and they're always doing stuff behind the scenes, and then they bring a product out. It can work, it might not work, but with the brand that Apple has, I wouldn't be surprised if you have more of a AR, augmented reality, being the first iteration of people really having alternative reality. So you have maybe glasses to start, and then you can get into aggressive VR in the 2030 plus time frame. I think Facebook trying to go immediately for this virtual reality world where you work all day and you come home and strap on a helmet basically and go into this world. I just don't think people are ready for that or interested in that right now. I'm not saying they won't be in the future, but maybe there is an in between step, which is, oh, you put on these, glasses like Google glasses, tried a while ago, and then boom, you then see, interesting information about the world around you. Or, I'm someone who thinks that holograms might be of interest, especially if the wireless and broadband technology gets better and people can create apps for that. So that's one thing I'm thinking of. But in terms of a broader discussion, I look at what Metaverse has written and talked about in their last earnings call. They are highly focused on aggressively ramping the Reality Labs employment, but with that said, they're keeping employment the same or slightly less through the end of 2023 as compared to now. And that's a major change from what they've done in previous years, where they've jacked the employment up by a ton. And I think this is going to be a theme that you're going to see where, we said that you didn't have to do much work in the 2010s for some of these growth companies. Well, a lot of these growth companies and the Googles and Facebooks of the world, I'll throw Amazon in there too. They didn't have to do much work managing their employment because things were going great. People didn't really care about margins as long as the revenue is growing. But Facebook's letter, Google's letter, they talked about this too. These guys are pulling back and hiring. And I think we've all seen these TikTok videos of day in the life of 25-year-old product manager at Google or Facebook, and it's a complete joke. I mean, this is just. I mean, we talked about this on our show, and TB, my co-host of the Woke Antidote, he mentioned he sees this all the time in the tech world where people are doing very little work all day. So there's a ton of fat to cut. Not every company has to be Elon and Twitter, where he's cutting 75% of the staff. But let's be real here. If Elon is able to cut 75% of the staff and Twitter works as well, if not better, and imagine he starts doing new products and developing that, then I truly think you're going to have a wave of activist investors. We've already seen this with Google, but you're going to have investors write letters and pressure the boards of these major tech companies and say they're going to use Twitter as an example, and they're going to say Twitter just fired 75% of their employees and they're better than they're working now. There's no way that you can't cut off 10, 15, 20, even 50% of your employees at some of these big tech companies and not be as well, if not better off. So you're going to see that the companies are doing some of it now, but could it get worse and a lot worse? I think absolutely it could.
Yeah, and I'm looking for that as well. I think it's not only it's it's also part of Jerome Powell's mission, I guess, so to speak, and what he was saying in all of his latest Fed meetings where he's talked about that. I think if the quote, maybe I don't have it exactly, but the quote was, uh, if unemployment increases, it's not necessarily looked at as a success. Man, I'm tripping up right now, but that means the raising the interest rates would be doing the job. So I think we're kind of seeing two things here. We're seeing obviously the Fed raising interest rates at a pace that's never really been seen before. And then two, growth companies kind of feeling the pain of that and feeling it a little bit more, maybe like a little bit exponentially compared to maybe some of these other companies who were a little bit, I guess, better managed. Didn't have as many people kind of running around making these TikToks, just running to coffee shop, working like 2-3 hours a day and calling it an 8-hour workday. So yeah, I think that's going to kind of continue, and I wonder like what's the solution here, and where are all these people going to go? Because I think like a lot of these jobs, man, like if you're yeah, I guess high up in some kind of marketing in or something along those lines, maybe that's a transitional skill. But some of these tech jobs, if you can't jump to another tech company and there's, you're, I don't know, a coder or something like that, and there's a hiring freeze in probably majority of these tech and growth companies, where are you going to go? That's where I think is like a lot of these high end, earners are going to be losing their jobs. And then where does that leave areas like, that people have kind of moved and, bought really nice houses and other things like that too. So I definitely see it all kind of crumbling, and it's maybe because of the big overvaluation of a lot of these tech and growth companies. And obviously, like you said, it's not really their fault or the company's like leadership's fault, because they were being rewarded for just, hey, bring on a bunch of people and then we'll figure out what to do with them eventually. And then these people got comfortable and didn't really have to work because they brought in these people for future work. You got to train them for a couple months or a year, and then these people just kind of found out, hey, I'll work at this company for 6 to 9 months to a year, and then I'll just bounce to another one and I'll get a 15% raise. And they just kind of keep doing that. And these tech companies kind of almost seems like they kind of killed each other from the inside, at least from my perspective, by doing that and allowing a lot of these people to kind of come in and not really have to work super hard. So I don't know. I mean, I feel like this is a lot of doom and gloom on growth companies, but do you kind of agree with what I'm saying here? And is there anything else that you're a little bit, I guess, more worried about as well?
I do agree, and I would throw in the stock-based compensation. That's getting a lot more attention now, both from the investors and presumably from the people that were getting a lot of stock, because that was a huge way that companies were and continue today paying employees. Well, if you're spending $1 billion in stock-based compensation and your market cap is 100 billion, not that bad. That's reasonable. You're giving away 1% of the company a year, but you're attracting really strong employees by giving them a lot of stock. Well, what happens to you if your market cap is now 10 billion? Now you're giving away 10% of the company a year? No way. So they're going to keep dropping that stock-based compensation over time, because there's no way they're going to give away much higher percentages of the company. But what that's going to do is they're going to have less employees, and they're going to have less happy employees. And oh, by the way, those employees, they thought the company was maybe at 100 billion. They thought it was going to be worth 300 billion in a couple years. So they were more than happy to take a large percentage of their compensation in stock. And this was public at Netflix, where apparently a lot of the employees kept taking, they had the choice of like kind of what the majority of their compensation would be, stock or cash, and they took stock. And frankly, it's hard to blame them. Not everyone's a financial analyst like me and you looking at this stuff and saying, oh, they have a high PE ratio or enterprise value over EBITDA multiple. No, they're at the company, everything's working, the market's rewarding them, they're thinking everything's great. And how can you blame someone for doing that? They want the most upside that they can. Everything that they're doing, all the data points are telling them things are working great. Why not double down and keep on, taking as much as you can in stock? So I think that's going to be a big issue as well. Where and you might go to new companies. Like if you're a tech worker, you might go to new companies now that have had their stock prices decimated, and then try to get more stock at the low price, as opposed to your current job. You might just be screwed. You might have gotten all the stock at 10 times the current valuation. So I think that's one element. I totally agree with you on the slowdown. And I'm sure you've seen this, because I've seen this on FinTwit and whatnot, where you've got people that are saying, oh, these tech companies firing people and slowing hiring, that's an isolated incident. If you look at the general US economy, tech is, I don't know, 4% of total jobs. So it's only FANG companies, it's only hot startups firing people. This is not going to impact the broader job market. To that, I say, I don't think you're paying attention to anything else, because it's not just tech companies, it's everybody. I mean, and I think we've seen that with Amazon now, because yeah, you could call Amazon a tech company, but you could also call them just kind of a general barometer of the economy. You could do the same thing for the FedEx story. That was incredible, where FedEx is laying people off right into the holiday shopping season. So you've got all these consumer focused companies too, that they had such high inflation. They raised their prices considerably over several times, but then they also went like, all right, if we can't do one more price hike, then the next thing we got to do is address margins, and then we're firing 10, 15, 20% of people to do that. So yeah, I don't think it is a tech only situation. I think it might be more aggressive there, but the unemployment picture I don't think is that great. Although having said that, admittedly, I'm not a macro analyst focusing on unemployment very specifically. So, is there going to be an impact from this? Yes. What's the severity of it? Is the severity going to be high enough for the Fed to change course? I think that's kind of where everyone's kind of waiting on, because as we saw when the other day, when there was one data point. I think what was it? It was inflation was like 7.7% instead of 7.9%. And the Nasdaq's up like 7%. The shitco's, the growth companies are up 20%, 30%. So I mean, the market is ready to rally, I think, when we know that the Fed is going to pause or considerably slow down rates. It's ready to start ripping. It's just a question of when they're going to do that, and everybody, you don't want to falsely get caught, but then you also don't want to miss it. And so I think that's why you have this insane volatility, where yeah, inflation's different by a little bit, and then boom, let's buy into stocks, because if we have a few inflation prints that are better than expected, we're going to keep on rising.
Yeah, and I think you kind of hit on something that I want to dive a little bit more into about the stock based compensation, because I think like you said, why would you blame anybody for taking some payment in stock? Because it seemed like at that point stocks like you said only went up, right? That's the Dave Portnoy, the El Prez kind of Davy Day trader famous quote. But I think it was people were just more willing to kind of take some of these risks on not only just stocks and their compensation, but we also see like a lot of these things with offering yield and the crypto stuff. And that's where I want to kind of bring up like FTX, right? We've obviously seen this huge FTX crash. It's been all over FinTwit and everything like that. You got a company that I think lost $18 billion or so in like 72 hours. So, we're seeing a lot of these big companies. I don't even know if I consider FTX like I guess they're technically a tech company. But, we're seeing a lot more of this, these companies kind of blow up it wasn't only just like kind of retail investors that were willing to take this risk, right? I think, too, like a lot of venture capital firms and other places like that were seemingly willing to take a risk on this guy Sam Bankman-Fried, and with I guess a slight history of making some money by figuring out one spread or something like that, between Bitcoin in China and Bitcoin in the US, and just kind of capitalizing on that. But at the end of the day, I think not it's not only just like you said, these FANG companies. We're seeing like a lot of these other companies rise up and get multi-billion-dollar valuations in a short period of time and then come crashing down. So I mean, I know this isn't necessarily like a crypto slash Bitcoin related show, but a lot of these companies that kind of jumped into this field benefited to the low interest rate environment, and the easy access to capital that a lot of these growth companies benefited from as well. And we're kind of seeing that all crumble, and it's not just like US based companies. It seems like they're more global brands too, and they were slapping marketing all over the place, and kind of stuff like that. So I mean, obviously, if you take a dive into the story, Sam Bankman-Fried is a fraudster, and there's really no other way to kind of word that. And the way he kind of did everything. But I also think like the banks have to be somewhat to blame here, because they allowed him to borrow a bunch of money on this, shitcoin crypto kind of thing. And I think that, maybe we might see some people that got stock-based compensation. Maybe they got a mortgage on some of their stock evaluation prices that were highly elevated, and now they might have to default on that mortgage, or other things like that too. So I think it's not just it's not just retail and people that were kind of working for some of these tech companies. I think just overall, the risk that people were taking in this decade of just massive growth in the stock market, it's just all kind of coming to roost at this point, and people are going to start to feel the pain. So what are your, I guess, opinions on this whole FTX, and I guess the crypto kind of debacle? I mean, obviously we have our opinions, and we're Bitcoin only guys, and but yeah, I'll let you kind of get into the fraudster of Sam Bankman-Fried.
Yeah, I agree completely that FTX, regardless of whether this is a crypto focused podcast or not, is extremely important to discuss when thinking about this growth tech bubble, because you had FTX, I think that went from something like 1 billion valuation in 2019 to 32 billion by the end of 2021, and you had incredible investors. I mean, it's easy to make fun of Tiger Global and SoftBank because both of those companies have done tons of VC deals, and a lot of those are now looking pretty bad, the ones they did over the last couple of years. But both those companies have had successes other places too. But then you've got very high reputation investors like Sequoia, like Temasek, which is, I think it's Singapore's sovereign wealth fund. You've got Dan Loeb, I believe, was in there. You had so many of these TradFi, traditional finance companies, participating in FTX too. And so you had those, Temasek and Sequoia, they specifically both came out. They addressed how much money they had lost in it, and they had talked about the due diligence they did, which they are at least claiming was several months of due diligence. But I think ultimately what we have here is the incentives. This is my take, but the incentives are always going to drive human behavior, and by proxy, by extension of that, by the human behavior of someone running a fund that can invest billions of dollars a year. So what the Fed was incentivizing for all these years in the 2010s was low interest rates environments mean growth metrics are going to be focused on by the equity market. And so if you're a VC investor, the way to win is to invest in companies that are going to keep on growing, and then you can have much higher valuations later. So when the Fed goes from ZERP to 5% interest rate trajectory on the risk-free rate, yeah, that's a massive change in your business model. All of a sudden, everything that you thought you knew about how these companies are going to perform for a decade changed. So it's easy to hate on the VCs, and I don't like a lot of the VCs either. I think somebody like A16Z, this has been getting a lot of heat now on Bitcoin Twitter. They just seem to be investing in these crypto Web3 projects with very little to no utility, and they're selling the tokens and they're making money that way. So I'm not saying I'm not hating on A16Z, for example, But what I am not happy with, and it's not only VCs, it's the public markets too. Your average retail investor, why wouldn't they buy the Nasdaq at 15,000? Because they want to buy the fastest growing companies, and interest rates were going to be zero for several years, mid 2020. It's the same thing with VCs. Why wouldn't they invest in the fastest growing companies? Yeah, it might be a high valuation, but it's going to be much higher going forward. So the Fed just completely switching it up, I mean, that's affecting everybody. And, like for example, let's transition here from the VC market to the bond market. Because that's one where, that would be seen as sleepier, right? It's part of that 60-40 portfolio, 40% bonds in an investor's retirement portfolio. Bonds are done by, pensions, by insurance companies, by asset managers that are focused on low risk. Bonds are seen as kind of this lower risk offset to stocks in a lot of organizations' portfolios. Well, bonds, if you had long duration bonds, if you bought a Google bond at 1.7% coupon rate in mid 2021, that bond's trading for 55 cents in the dollar now. If you were a company that was investing in junk bonds, high yield bonds, you were buying bonds at 3% in summer 2021. Those bonds are at 70 cents in the dollar now because they have to be 8% yields. So it wasn't just VCs that were impacted. They were impacted the most because they're the highest risk segment of the investing class. But it was also bonds. It was also clearly public equities. It was also real estate. So it was just that the volatility itself is hurting everybody because you're making decisions on investments, you're making decisions on your personal expenditures going forward, like you talked about, maybe people buying real estate. You're making these decisions under the assumption that the current economic paradigm is going to continue. And then when it's changed so rapidly, it's hard to react to that. And I mean, frankly, you could even think about if you're an investor in the space, any asset class, 20 you had a decade, you had 2010 to mid 2022, let's call it, of a certain paradigm, and now that paradigm has shifted. You have to decide now, do I think the paradigm's fully shifted, and then do I need to change everything I knew about making money and being successful for the past 12 years, or do I think this is a short-term thing, the Fed's going to cut interest rates again, and this is a great time to buy because asset prices are so much lower than they were for the past few years. So that's a really hard decision. And I would argue, and I think you would too, as Bitcoin people, that shouldn't even be a choice. This severity of this change should not be allowed to happen. The economy should be natural. The interest rate should be naturally chosen on an open and free market. And we really can't have people in such power controlling the bond market, the equity market, the currency market, the real estate market. That's just not healthy for a society. So yeah, like not to get too kind of macro and focused here, but it's just really unfortunate. And I think like, going back to FTX to make my final point here, VC is like the most intense asset class, and then crypto VC is the most intense asset of the VC asset class. So FTX is like the tippity top. But what happened if you invested in FTX at a $1 billion valuation in 2019? You made out like a bandit if you sold some of your shares in the 2021 funding rounds, right? You were doing amazing. So, it's a very big fall, but it was also an incredible rise. And it's really hard to call when that rise is about to decline. So, again, like I'm not trying to apologize. I'm not trying to say for a lot of these people making these investments on crazy valuations that, they were actually smart and they lost 70% just out of luck. I'm just saying human psychology dictates that it's a very hard to call a change in the dynamic of the human behavior when we have something like this. So, I hope that kind of makes some sense, but it's just tough. And I think it's not only the VCs that are having trouble with it, it's long tenured bond traders who've been trading treasuries for 3 decades since the 80s. they're having trouble with it too. So this is not a problem in a specific asset class. This is a problem that's happening across the entire investment world right now.
Yeah, which is absolutely crazy, right? Because we saw house, like you said, real estate, housing, everything shooting up drastically. Rent shooting up drastically, and everything like that. And I think just overall, kind of to tie it back to the unemployment is that we're seeing obviously inflation just rise drastically and expenses rise. And when it comes to certain expenses, obviously we've seen the student loan forgiveness kind of be kicked down the road, and other things too, that a lot of these policies are, I guess, sort of helping the inflation in the short term. But I don't know, in my opinion, I think that everybody's expenses is just going to kind of continue to go up, obviously, when you have to start making some of those student loan payments. Anecdotally, I have some friends that are just waiting for that 10 grand that Biden promised to
Mhm.
magically make that student loan disappear, and instead of making the payments when it's a zero interest rate environment. And so I think that companies are not really in a great place. And overall, just the entire macro environment, we're just seeing inflation just kind of cripple the economy. So at this point, like, what is the Fed to do? Like, what is your outlook on things? Do you still think that there's, like, obviously there's value in every market? At some point you're going to find some company that kind of thrives in this environment. But what do you see? I guess this is kind of, obviously it's a pretty tough question, but how do you see us getting out of this? And do you see it as kind of I guess a slower sideways, drastic, bloody recession, depression, or maybe us getting out of it here in the near future?
Yeah, I think I do see, like we talked about Google and Facebook before. Companies are going to cut the fat, so you're going to have margin improvements that way. I think for a lot of these companies, the problem is obviously that the revenue is not going to be growing as much. So in those companies, for example, you're going to have advertising declines, going to be hurting them. But I do think there was excess in the 2010s, as we talked about. So there is some fat to cut. So I think there are going to be companies that can benefit there. I think there's another version of the valuation declines that me and you talked about it much earlier, where some companies that have great businesses that might be negatively impacted over the past couple of years for various reasons, they're being left for dead. So what you're going to have is companies that can actually come out of the pandemic-induced declines at a nice rate of growth. I think they're going to be fine too. So there's companies out there that the valuations have hurt, and those might not be growth companies. Those might just be a small cap company that, oh wow, maybe this company, people thought they have too much debt, they're not going to be able to refinance it, and it's going to trade, like it might go bankrupt soon, and actually, oh wait, no, they can sell some assets, they can cut a lot of costs and get out of it. So I think that could be somewhere to look as well. And then I think again, it's like you got to find the companies that you believe have great business plans that can work in the future. And I would say, okay, so if you're a company that is out there, a business plan that could work is providing a better product at a similar to lower cost. So I think we're seeing that. For example, I look at the broadband market a lot, and there's all these companies out there. And I'll take T-Mobile for example. They're offering broadband over wireless for a lot less than your typical wired connection, whether it's from cable or fiber. Verizon's doing this too. So if you're a company that you're potentially offering a better price than the incumbent provider of a service, then you can actually start growing. I'll use Oracle as an example here as well. They talked about how, like, Larry Ellison is the big guy at Oracle. He's saying that you know listen to us next call. We're going to have some surprises for you of customers we're winning from AWS, from Amazon Web Services. So that's pretty interesting. And if you look at Oracle, their cloud business, it's not in the top three, with Microsoft, Amazon, and Google, but it's growing pretty fast. So, that could be an interesting insight where maybe someone goes, I like, for a variety of reasons, I like what Oracle is doing with their with their cloud. I think they can take share from the incumbents at a better price. I'm going to go ahead and do that. So, I think it's going to be much harder. These are deeper level of analysis, but I think that's an example of, for whatever reason, if whether the organization's set up better, whether you specifically have better technology, whether you have better assets, there's ways to take share from incumbents at a better price, then you're going to be able to do all right. I think if I broaden it out to the macro perspective, yeah, it's hard to make a prediction. I totally agree. It's hard because on one hand, you have so many of these companies announcing the job cuts, but on the other hand, it really, at least in terms of the publicly available data that they're giving us, it's not really showing up yet. And on the flip side, maybe you do have more jobs and energy because there needs to be an offset. So, I'm not convinced that the data is going to come in that great going forward. I think the Fed will have to pause, and I think they're already taking us down from 75 to 50. So I'm much more on the side of the economy will slow pretty aggressively in the 2022, 20 and late 22, early 23 timeframe, and that we're probably going to have to at least initially pause. More data comes in, and then you're going to eventually have to have a cutting cycle. Maybe it won't be back to ZERP, maybe not to zero, but you're going to have a cutting cycle that, as soon as the first cut is being priced in, that's going to have the market rip. And then ultimately that's going to be dependent on, on one hand, the Fed's going to have your back again, because I don't think we're going to be at 5% for a while, but then earnings are going to be down. So I think the best case scenario is just finding the companies that can at least maintain consistent earnings, and then you're hoping that by late 23 you're going to get a tailwind from the Fed easing considerably. So you go into those companies, but yeah, it's a hard time out there. I mean, I'm in the investment community. I'm doing this every day. I don't think that many people are. I wouldn't say having success, because I'm sure if you're a short seller and whatnot, you're doing all right, but I think this is a very volatile time, and I think a lot of people, if you think about, whether if you think about 2008 or the 2000, I mean, those are the last two times when there's a big deep crisis. A lot of the investment professionals, they came after those, so they never experienced those. Yeah, you experienced 2020, but that was a very quick snapback. But people working today in pretty big positions, because think about it, if you started working in 2010, so that's 12 years of experience. So you've done, people have done a lot. They've moved up in their careers. They're probably managing a lot of money. You haven't seen a market like this, and now clearly no one's seen a market like this, but you haven't been through and had survived the 2000 and a 2008. So you're looking at the paradigm shifting. And for example, like on FinTwit, you see some of these accounts will tweet out the investment letters of hedge funds that started operating maybe like the mid 2010s. Fund was up 100% in 2020. It was up maybe 20% in 2021. It's down 60% in 2022. And you hate to see that, and you wonder if that company is going to immediately see a bunch of money withdrawn. But that's an extreme example of what I think a lot of companies are finding now in the investment community, is that, oh, wait a second, what I did for the last 10 years or the last 5 years of my career, it's just not going to work. I need to develop some other skills. And the ironic part is that, you know, once they've made the decision to look elsewhere, to have a different investment perspective, and they learn that, that's probably the exact time they actually should be doubling and tripling down on what got them their investment success in the first place. So it's a time of upheaval. But for someone, I think if you're living through this, whether you're a young investment professional or whether you're a Bitcoiner out there, and maybe you bought a little bit of Bitcoin at 40, 50, 60K, and you're a little nervous now, these are the times when get really familiar with the asset. So, if you're a Bitcoiner, if you haven't read the Bitcoin standard yet, get on that ASAP. Get familiar with the asset. See if you truly believe in it now that it's down 75%. And if you do, go hard, because you have less risk investing in something when it's down 75% than when it was much higher. So, get the pencils out, do the hard work, read, And I think, yeah, the market, look, the market, when a company is at 100 times, multiple, you're just going to be better in the long run when it's at a 10x multiple. So I think that's the silver lining here, is you're going to be offered better deals on a lot of these investments. It's just you have to do the work now much more than you had to do in the past to actually make alpha and beat the market. So, maybe we've had a lot of doom and gloom in the pod. Shouldn't be all doom and gloom. There is some positive light at the end of the tunnel, but yeah, I do think it's more than reasonable that the economic situation isn't pretty for the next year. But I think ultimately there will be that light at the end of the tunnel at some point.
Yeah, and I agree with you, and I do think that there's going to be a light at the end of the tunnel. At the end of the day, I do believe in the entrepreneurs of America and kind of what has built us up to where we're at as one of the world powers at this point. Whether we're kind of declining or not, that's for a completely different pod. But SB, you've been very generous with your time, so I appreciate you coming on. I always love having these conversations with you. Why don't you tell everybody where they can find you and what you got going on?
Yeah, so definitely check us out on Twitter at the Woke Antidote. We didn't get into politics much today, but we've got a view on politics. We like talking about it. I mean, frankly, just from the name, you guys can imply what we're all about. But yeah, definitely follow us on Twitter. And then we were doing a podcast once to twice a week. We've had some life changes, so it's been more sporadic recently, but we're definitely going to try to get rolling again. And so yeah, just give us that follow button on Twitter, and you guys will be, you'll get the notifications for when we do have the pods, and certainly, we got a good group of guys in the spaces that we talk to, and so I think, we'll have plenty of good content coming from Woke, whether it's at Woke with you guys, whether it's on your pods with you guys. It's just, there's a lot to talk about. It's not only the economy. I mean, me. I mean, when you came on our podcast, we talked for almost 2 hours and maybe did a one segment on the economy. So there's so much to get into. So yeah, definitely give us that follow. Hopefully you enjoy the pod, and we'll tweet out some greatest hits of what we've done in the past too. So scope through the archives and see what you guys like.
Yeah, for sure. I couldn't recommend their pod, more, to be honest. I mean, SB and TB, they both bring unique perspectives, and it's, all kind of related at the end of the day. I know some people don't like to get into politics or whatnot, but as we've seen with, a lot of these decisions being made, it definitely affects the overall economy. So it's something to, keep an eye on for sure. So SB, thanks so much. Why don't you take the rest of this afternoon and jam out to a little of the NSYNC's Christmas album? And
Oh
yeah,
yes.
I'll talk to you soon, buddy.
Well, and to finalize, I just heard that Trevor Simeon actually isn't starting potentially because he
Oh,
got injured in warm up. So the Bears might be down to their third string QB. So yeah, we'll see if they can pull off the W or not.
Nathan Peterman. I think last I saw too, the spread went from like Bears almost favorites or close to favorites to like 6.5 point dogs. So
Oof.
I'm gonna have myself an afternoon having to sit through that. So
Yeah,
um,
best of luck with that one.
yeah, I appreciate it. Well, SB, it's always a pleasure, my man. I'll talk to you soon.
All right, cheers. Thanks for having me on.